Welcome to the Broken Pie Chart Podcast, episode 127. Yep, we made it to 127. And next week, hopefully, we'll make it to 128. But this week, we're going to be talking a little bit about the interest rates that matter to you, how you can watch them, what you can infer about future interest rates based upon the actual trading prices of various futures contracts. I'll explain how that works. And then we'll get into, some of the ways that, on a practical sense, many of you may have let's say like a 5-year ARM, 10-year ARM, where the mortgage will reset, or maybe you have a home equity loan or other type of loan. A lot of these loans are based upon a certain interest rate and then a margin against that interest rate, meaning they add a couple, like 3% plus LIBOR, or 2% plus LIBOR, or 2% plus the continuous maturity of the 5-year, treasury rate. So I want to give a little bit of a practical sense of how you can use this as well. So first, the interest rates that matter to you, or maybe the ones that I think you can watch. There's all this talk, and 2 weeks ago, of course, we did an episode, Don't Watch the News, Just Watch the Data. And this is going to be another one of those type of deals here. A lot of people are speculating about, hey, is the Federal Reserve going to raise rates? Are they not going to raise rates? By the way, what does the Fed funds or the Fed raising rates even mean? And so any number of people are going on TV, on CNBC, Fox Business, Bloomberg Television, Wall Street Journal, any number of these outlets, and making predictions about what's going to happen to future interest rates. We know that the PCE that was just released, which is the one of the inflation indicators along with CPI, those have been really high. In that Watch the Data episode 2 weeks ago, that was episode number, This is 127. So that was episode 125. I kind of went over the things to watch when you're watching inflation. But what's interesting too is, by the way, inflation has continued on a year-over-year basis, and I encourage you to go back to that episode because I do cover this. It has been higher, but yet the bond market rates have been falling, and there's any number of reasons for that. So let's first talk about things you can be watching. Obviously, the Fed funds rate, and so the Fed funds rate is the Federal Reserve Bank. They set a target. Their target right now is 0% to 0.25%. And most recently, the actual Fed funds rate has been about 10 basis points. That's 0.10%, right? So if it was 100 basis points, it would be 1%. 1 basis point would be equal to 0.01%. So it's trading at 10 basis points. And when the Federal Reserve makes changes to the rates, typically what they'll do is they'll change their target range from the Fed funds rate. So if they were going to raise rates, if they were going to go up a full quarter point, they might go from 0 to 25 to 25 basis points to 50 basis points, so 0.25% to 0.5%. But anyway, I'm going to talk later about how you can actually pull up the futures market and what the futures market's implying, not what people are saying on TV, what the actual markets are sort of trading at. And from there, you can derive probabilities. I'll link to a previous episode I did. It's probably over a year ago now, where I talked about using probabilities for interest rate changes based upon the futures markets as well. So I won't be covering that today, but I encourage you to look in the show notes and grab that episode as well. Okay, so a couple of these rates. We talked about the Fed funds rate, but then there's different rates, and there's things that we use futures markets to imply the rates. And so the Fed funds, there's actually a Fed funds futures market, and the Fed funds futures market has actual trading prices. And the way the futures market works, I can buy a contract, for example, that is, for, let's say, expires September 22nd of this year, and its current price, or the mid price, and the market's not open right now. So these are kind of stale quotes from the close on Friday. But the mid price was around 99.91. And so when you see that, a lot of these interest rate futures markets, you get an implied interest rate if you take 100 minus the price of the future. So 100 minus 99.91 is 0.09. And guess what? What do we say the Fed funds has been trading around, or the Fed funds rate has been? It's been about 10 basis points, so 0.10. And the implied Fed funds rate from 100 minus the futures price is 0.09%. So pretty close. But the reason why I say this is there are futures contracts. There's ones I can see on here, at least on the CME group, the Fed funds watch area, where they actually do have probabilities of future cuts or, changes or not changes. But I can see contracts that go out to February 1st of 23. So if I'm looking at this here, I'll pick the January 26th of 22 contract expiration. Its mid price was 99.915. Mid price just means, the price sort of between the bid and the ask on those. And if I take 100 minus that, guess what? It's actually implying about, 0.0. I got to do a little math. This was easier before. 0.085%, right? It's actually a little bit lower. But again, these are the market's not open right now. I'm not using, active data pricing. These are as of the close. And so if you're looking at that, you would say, okay, based upon the implied price, what's going on there? Well, in this case, it's not really implying much outside of what currently is. Now, if you go all the way to February 1st of 23, which seems like its price was 99.72. So 100 minus that, you get, 0.28% is the implied Fed funds interest rate. And that would be higher, not too much higher than the 0 to 0.25% target rate right now. But there you actually get some probabilities that the Fed funds rate would be, lifted by about, 25 basis points with a 40% probability. Those probabilities will change based upon the prices. So I would encourage people who, are watching the talking heads and giving their predictions about what the Fed will do. Go ahead and look at the actual futures markets. These are people who are trading. And they could be hedging, they could be speculating, they could be any number of things. But these are actual trades, people putting money into the market, expressing some sort of an opinion. So I like to look at the futures markets and see what people are actually doing rather than saying. So the other interest rate one that you can take a look at, it's called the Eurodollar Futures. Now, this may seem a little confusing. Eurodollars, maybe I'll do a whole episode on what Eurodollars are, but Eurodollar futures are actually, from there, we can imply the 3-month Libor rate. And so this is, Libor, by the way, is the rate that most loans were based upon. And they're in a process right now of sort of trying to switch over. And you can Google Libor rate controversy, put it that way. There was some controversy around how the rate was being created and who was setting the rate, things like that. You can Google that. We're not going to cover that on this episode. But 3-month Libor, which means the rate, 3-month rate, so a very short-term rate. I'll bet you if you had a mortgage, variable rate mortgage, or home equity loan, any number of things, chances are the loan was based in part on the Libor rate. And there's one-year Libor, there's 6-month Libor rate, but 3-month Libor was a big one. There's still loans, by the way, that are still based upon Libor. But same thing. And you'll hear a theme. I'm going to say you take 100 minus the price of the future. And so if we take 100 minus the price of, let's say, the September of this year's future, it implies it's 99.88. So 100 minus that, 0.22% is the implied 3-month Libor rate based upon the futures price. And so what this lets you do is it lets you go ahead and take this and look and say, okay, December of 22. So what's the price there? It's 99.61. I'm just using the last price. So again, I'm doing this when markets aren't necessarily open, right? And by the way, it depends on how active the contracts are. So if you go out further and further away from the current month contract, there's going to be less price discovery, less volume on those. But the December about 99.41, which implies about a 0.39% 3-month Libor. Okay, so these are also, most of these rates are going to be on the CME, the CME group. I'll give you a link in the show notes, but if you just go to cmegroup.com, you can kind of poke around and find them. But I'll also try and give you some links to the actual contracts as well, so you can look at these prices. By the way, it's worth noting. You might see this and say, "Yeah, I'm going to start trading these." Don't do that. If you've never traded futures, or even if you have, nothing I'm going to say on this podcast would be a recommendation one way or another, or in support of you going out and opening a futures account and trading these. So a lot more that goes into those. So the other one that we sort of take a look at is the SOFR rate, secured overnight funding rate. And this is I think it's safe to say, the preferred replacement by the Federal Reserve for Libor. And recently I redid our mortgage, and it was actually it's an ARM, and when it resets, Libor plus a margin, and I'll explain that in a second. But it's no, I'm sorry, I said Libor. I'm just old habit. It's actually based upon the SOFR rate. So SOFR is secured overnight funding rate, and it's secured by treasuries. I mean, it's a secured loan, right? So, and it deals, it's got close lineage, right, with the reverse repo and repo market. But same type of deal. One of the most recent quotes was 99.95. 100 minus that is 0.05. So implies the SOFR rate at 5 basis points, or 0.05%. And so the other one, now there's no futures on this, is it's BSBY, BSBY. It's a Bloomberg short-term bank yield index, I think is the acronym that BSBY stands for. And it's based upon, the rates on CDs, commercial paper, bank deposits, short-term bank bond trades. I think these futures are coming out on the CME at the end of August. At least that's what I read. And there's a lot of, some people want BSBY, some people want SOFR, some people still use Libor. But the reason to bring this up is all of these, and eventually BSBY, they'll have futures markets. And like I was just explaining, you can take 100 minus that, and you can sort of figure out, okay, so what is the implied interest rate? And because futures markets have forward contracts, meaning not just this month, they have contracts going out, as I said, February of 23. Here, I'm looking at the Eurodollar Futures contracts, and they've got one on here, December of 24. I don't know how much volume there is on that contract and how, but anyway, it's so here's the practical thing for many of you. So a lot of these variable rate mortgages, or as I said, loans, maybe it's a home equity loan, all those things, right? Not going to say whether you should do a variable or a fixed or anything like that. Maybe we'll cover those in more detail about the pros and cons of each at some point. But chances are, if you have maybe a 5 or a 10-year ARM, that's an adjustable, ARM stands for adjustable rate mortgage. If you go ahead and you look at the terms of that mortgage, and you look at when it resets, let's say you have a 5-year arm after it's fixed for 5 years, and then after that, it's variable. And it's variable, but it's going to be based on some underlying interest rate. And so typically, you might see it based on a rate, but you might see what's called, plus or minus a margin. And I'll explain. So let's say if you have a SOFR loan, it might say, okay, it's going to reset at 3% plus SOFR. Okay, so if it was resetting today and that was the terms, it would reset to 3.05. And sometimes these have floors in them, sometimes they don't, those types of things. If it's a 3-month LIBOR, it's another Libor rate, you might see, some percentage plus or minus that. So, and the other one you might see is there are adjustable rate mortgages that or loans that have for the reference rate or the determination of what the rate will be. It might be some margin plus the interest rate on, let's say, the 5-year Treasury. So the 5-year Treasury closed a little bit below 0.7% on Friday. But let's just use 0.7. If your margin is 2% plus that rate, the mortgage will reset at 2.7%. Okay, I'm giving a very broad overview on that. But for a lot of you who probably signed these mortgages and there was some rate and it's going to reset and maybe this floor is a minimum or a maximum, all that stuff, right, beyond the scope. But take a look at your mortgage and see what the rate is. And then you can go ahead and you can start looking up, what these are, okay? So important things. Now, the other thing I wanted to just sort of, couch some of this in is the idea that these things can change. And so let's say if you're looking at one of these rates and you do your 100 minus the rate, or if you go to the CME, Federal Reserve Probability Tracking Tool, or FedWatch tool. I think it's called the FedWatch tool. What they do is they also can let you do a historical look. And the historical look is, so for this, I can look at the March contract and of 22. And I think the meeting date is March 16th, right? I don't know if I misspoke and I said the expiration date or the meeting date. So if you're listening to this previously, I gave some dates. Those are the meeting dates, right? Okay. So let's look at the March 22. And, on June 16th, so not that long ago, the probability of a rate increase, so 0 to 25 is the current target range. And their probability was about 78.8%. Again, I encourage you, I'll put it in the show notes where I went into more detail about how these are calculated, but safe to say that so the probabilities increase when the futures contract on this particular, align with this particular meeting date when the price changes. And so, let's say it's not, but let's say the price went down to 99. That would be implying a 1% Fed funds rate. And so, there'd be a high probability that you're going to get an interest rate increase, all right? But anyway, so if I look at the day of June 16th and see what the probabilities were, and then I'm going to fast forward it to the most recent day, there was a 78.8% probability that the Federal Reserve will keep rates exactly the way they are. There was a 20.5% probability of a 25 to 50 point target range. So that would be raising the target by a quarter point, right? 0 to 25 to 25 to 50. So a quarter point to a half point, right? And then it was a 0.7% chance of them doing 50 basis point move. So that's a half point move, and it would be 50 to 75. So that's on June 16th. And then we're not that far away from, where we were. This is July 29th. And remember what I told you? Well, now on July 29th, there's a 96.1% probability that rates will remain unchanged, 0 to 25 basis points, and only a 3.9% probability they go to 25 to 50. Remember, I just told you the probability is above 20. And so my point of sort of explaining this is these move around. They're going to move around based upon what buyers and sellers are doing on these futures contracts. And of course, I mean, the things that, Fed officials say, things that people say in the media, current research on Wall Street, sort of, all that plays into people's actions in the futures market. But this is a good way of sort of looking and seeing what the trend is. And if you have a variable rate mortgage, now you sort of know, hopefully you know where to find those rates. But go ahead. I encourage everybody, if you've got one of those mortgages or a home equity loan or any type of loan, even a credit card, see what the rate is based upon. And then you can actually, you can take a look and find the rates. They're easy enough to find. Most of the stuff, gladly, is posted online these days. All right, the other thing I wanted to mention real quick was that currently my book, Broken Pie Chart, where I go into kind of new ways of designing portfolios. I talk about risk management, the problem with target date funds, the risk on bonds when yields are really, really low. Some of what I think are the better ways to measure. I look at the Sharpe ratio versus the Sortino ratio. Towards the end of the book, I get a little more technical there. But I wanted to point out that it looks like Amazon has the hardcover at it's like $10.96, which is a great price. So if you haven't picked one up yet, by all means, I'll put a link in the show notes. But go to Amazon, just type in Broken Pie Chart, and got a really nice price. It's discounted. Normally, I think it's they usually sell it at least for $30 or something like that. So good for anyone who wants to pick up that book. Of course, the Kindle version is also still available. No audiobook though. Yeah, I was writing that. I wound up putting, I think, over 100 charts and graphs in the book. So it wasn't really that conducive to an audiobook at the time. You can imagine if you were reading it, or if I was narrating it to you, I'd say, hey, if you could see this chart, or go ahead and pull something up and you can look at the chart as I'm explaining it, but kind of defeats the purpose. So I think the next book I'll not have as many charts and graphs and actually do an audiobook version. All right. Please share this with other people who listen to podcasts, people who don't listen to podcasts. And of course, you can always start and review it and all that stuff. But I'd rather you just share it and hopefully you get some value out of this. Continue to give me ideas. I appreciate those who reach out and make suggestions about future topics. I've had some questions about interest rates and a lot of things of, hey, do you think interest rates are going up? Do you think they're going down? And I thought this was a good episode to do because this gives you the tools to go and look for yourself and see what the futures markets are implying. All right, folks, we'll talk to you next week.